Good day, everybody. It's Greg Schnell, and I am here with the market review for February the 8th, 2020. We've had an interesting rally this week, and it's actually a rally from an analytical perspective because there's lots of bullish news out there, quite a bit of weakness under the surface, and trying to understand the differences between those two. I'd say there were some pretty good hints this week that there's some significant underlying weakness that we need to pay attention to. So I think you'll enjoy the video this week just about learning about that or seeing the differences between the indexes. So to find my blogs, you can just go to any of these, and it's also on gregschnell.com, and usually I write a summary article there. Contact information, you can find me at newupdate@gregschnell.com, on Twitter at SchnellInvestor, or our website, gregschnell.com. And my agenda today, I want to cover off how the big names rallied this week. Obviously, Tesla was a wonderful story, and then breadth contracted meaningfully, and I want to show how I analyze that to say that, and then clues from different indexes. And so hopefully all of that information will help you out. And I also have a sale going on at gregschnell.com under the Private Investors tab. Select the annual membership, and it's 40% off. So hopefully if that interests you, that'll be available. Thanks, everybody. And then I'm going to jump over into Safari. What I want to show, just to start off with, is I want to work through the different advanced decline percentages. So this is the 1500 advanced decline percentage, and I started using this about 6 months ago, and it was an Arthur Hill idea. It was to use the 1500 instead of the S&P 500, and I do like it because of its unique properties, just a little bit larger than the S&P 500. So anyway, well, what I show here on the three different panels, the top panel, when we're looking at this is how the actual index is working. So this is the value of the index, like the value of the S&P 500, but in this case it's the 1500. And then in the middle panel is the advanced decline percentage, and it's a 2-week moving average. And then in the lower panel is the advanced decline percentage in what's called a cumulative mode. And when we do it in cumulative mode, I'll just show you how the differences look in the settings here. So up at the top, I've got it as a logarithmic setting so that the scale continues to maintain a percentage difference as it goes up. It doesn't look that much right now, but if we did Amazon or Tesla, you'd see the scale kind of contracting narrowly at the top. And then at the bottom here, the cumulative option for style, when you turn that on, what it does is it adds the difference from the day before to the next day. And so what we see here is we've had a gentle uptrend for the whole year 2019, and then here in October we had a run going on, and roughly middle of October this started to, middle of January this started to crack, and now we've made a lower high in the advanced decline percentage that you can see in here. Looking at it as a 2-week average, what you'll see is that part of this is the width or the length of the run that you had an increase in the number of advancers over decliners, and so a wide body here, and for the most part with these two little dips, really it's been 4 months straight up. But recently we started to see kind of a 2-week pullback, and then almost less than a week we bumped up and pulled back into negative territory, and it's that weakness that's starting to show up that I think is more important, and this is on the 1500, so it's on the largest group. So it includes the S&P 500, the 600, and the 400 of the mid cap and the small cap. And what the point would be here is to notice how the advanced decline line changes and how this percentage changes. It'll show up differently on the charts, and then we'll also see how the price action differs. So in this particular case, we've actually made a higher high on the rebound. So it bounced right up, and that's because a lot of the large caps carried the load. But what you'll see is on the small and the mid cap, so here's the mid cap, And on the mid cap, so these are the same settings. It's just that this is for the S&P 400 mid cap, and then this is the actual index itself up at the top, and this is the 2-week moving average. And as we went along, you could just see a gentle kind of run out, and then all of a sudden we had this thrust in September that started to kick things up, and now we're starting to run out of jam again on the mid caps here. So I've got a long trend line in place here for the advanced decline percentage, and historically, or when these start to kind of break big uptrends in advanced decline information, it's also a good clue to be watchful about the overall market condition breaking. So if we unwind the tape here just whatever 3 or 4 years, what you'll see is some really long patterns where it runs up. And then we had the big break in 2018, and now we've had a long run up again. It's because the scales, I've got 2 different panels here, so that's why the line didn't follow properly. But it doesn't know which one to orient around. So it'll only adjust one. It'll only keep the first one, and then the second one, the line will move with it. So what we've got here is a pretty important inflection point for the mid caps, and you can see that we've made a lower high in the advanced decline percentage and really haven't done much since the middle of December. I think that's fair to say. Let's call it December 20th. And we had a brief spurt in January, just kind of one day where we spent a little bit of time higher and then not much since then. And on this rally, we got back up to kind of this level, but we had started to make lower lows. And so it's these lower lows that are interesting. You'll see that since October, we really hadn't made lower lows until this particular point in time. And now all of a sudden, starting to get a little fussier. So with that, the mid caps are starting to look weak. So the price action up here hasn't broken yet, but we can see on the advanced decline data that it's close to breaking that big uptrend. And the second thing that we notice is that both the width of the rallies, or the length of time of the rallies, and the power of the rallies is getting weaker and weaker as we extend out here. So starting to get a little bit concerned. Now, when we look at the small caps, what we can see on the small caps is this is even more obvious. And the reason I say that is, look at how severe this downtrend is in terms of the rate that the market was struggling to rally, and look at how big the downward move was in really since mid-January. And again, we're seeing this happen quite significantly, and we didn't get back up to the highs that we got to in December. So on the small caps, we had even less rally, and then on the mid caps, we had a rally back up to the same levels. And yet when we took everything into account using the 1500, so the large caps, which would dominate, obviously we made it up even higher. So we had a higher high, mid caps were kind of, just slightly off the high, and then the small caps were even smaller. So what we're seeing is that underneath the surface, there's a lack of buying into the smaller names, and a lot of the institutional investing, any of the bank funds and that kind of stuff, they're all going to be in the NASDAQ 50 or the NASDAQ 20 or the NASDAQ 30. They're going to be in a really tight group of stocks kind of tracking progress, and what they're looking for is stable earnings that they can plot on a graph and they all go up nice and smoothly. But the bigger issue is for a lot of the other companies, we're not seeing that same sort of buying interest show up, and that's what makes the market start to diverge. So back in 2018, we saw this big uptrend, and then all of a sudden the small caps really broke down. And when the small caps started to break down, that was pretty important. And then we had a choppy period, even on the S&P 500, where we went sideways pretty much for the whole summer. And then in October, we had the kickoff rally, and that rally took us up to new highs. Now, in the case of the large caps, they've obviously taken out their September 2018 high and went on for like a 10 or 15% gain above that point. But for the small caps here, we still haven't taken out the previous high of 2018, and it's that change in behavior that we're seeing, or the change in breadth of the market, whereas usually the small caps are kind of the fast moving, and they can give you a little bit more beta, a little bit more outperformance because they are so small, and when they kick up, they can run quite quickly. So it's that change in behavior that the small caps aren't really getting it going as much as just the large caps. And the large caps are, well, stretched is not even a fair expression of that. Maybe I'll just go get the chart here. Let me go grab a chart list right up at the top. What I want to show on this chart is that the momentum, it says I don't have anything like that named. Okay. So what I want to show is that the momentum on the NASDAQ is dramatically outperformed over a long period of time. I'm going to go to a weekly chart. And my point is that at this 4.575 level, when we get up here, I can put a horizontal line on top of that. So I'm going to put it at 4.575, and then I'm just going to make that line, whatever, red or something. And then with that, what we'll see is, so it's drawn this line on here for us. But what I want to point out is it's higher than the 2018 peak, higher than 2017. And with the exception of the QE periods, over the last 20 years, we have only been up at this level off the, might help if I make that height a little bit higher. So let me just push that up for a second. And again, what I'm trying to do is make this panel down here taller. So I'm increasing the height, and it compares it to the height of the main data panel. But what we can see here is that, off your extreme lows, you're going to get a big momentum change, and that takes about 6 months to get there. No big deal. Big rocket ship higher, and that's cool. Then what happens is you kind of lose steam, and as you lose steam, market can continue to go up or might go sideways. But what you're more focused on is just how resilient is the rally. And so in this particular case in 2010, kind of once we lost this level, we migrated sideways, and then we got more QE, and we rallied back up again, and then fell back down, and then we rallied back up again, and we got more QE. And these bumps don't look big because of the history. Up here now, we've rallied onto such a level in these NASDAQ 100 stocks that there's a lot of great comparisons right now of the run off the 2019 lows, and even some of them are comparing farther back, but off the 2019 lows to kind of compare to the tech stock run in the year 2000 when they were all just going ballistic. And if you do that comparison, we have another month to go where we'd get to kind of the March 10 high like they got back then. But the bottom line for me here is looking at this, what you see is we're up at this extreme level. And at that extreme level, really in all three of these cases, the market rolled over and gave us, if nothing else, a sideways correction. Now, this doesn't look like much, but 2,400 to 2,000 was a 15% correction. And so, if you're trying to protect your portfolio, 15% is pretty large. So we're up at this severe level, kind of a level we've only been at 4 times in history. 2 of them were coming off the 03 low, which was a 50% decline, in the 2007 market, which was like a 60% decline. So we've got these big drawdowns, and actually on the tech NASDAQ, this was probably even bigger than that. It was a huge decline. Anyway, the 2 big rallies that we've had, I would just say I don't think I want to use those as the comparison point, because we haven't had a massive 50% low or something. But I do want to point out that these 2011 and 12 periods were both QE, and recently the Fed started to add liquidity and is now taking that away slowly. So all of this is setting up to tell us that we're at an extreme. And my point would be what I want to watch for is, as the market goes here, how does the market participate? And we should see, if we have what we call a broad rally, all of the stocks in the market participate. So small caps, mid caps, large caps. And what we saw this week was a different tone where only the large caps kind of took off. So here is, let's just go through a few different views. So first of all, we have like the New York Composite, right? And this is just a group of all of the stocks on the New York Stock Exchange. And what we see is just, it was trending down, it rallied back up, and it couldn't get back above the prior high. No big deal. And we see this showing up on the daily chart. And what's happened here is as we tried to rally here, the momentum is a lot less than it was up at the previous levels. And when we do the same thing for the NASDAQ composite, what happened here was this took off to higher highs. And the reason obviously was because we had big moves in things like Tesla and Amazon and this outstanding kind of push up really kind of carried everything forward. So the index looked like it was doing really, really well. Now, when we see this, so again, remember how the momentum indicator for the New York Composite was way down around 0. This is barely dipping down. It's still lower than the prior high. So now we have what we call a divergence so far. Could continue to rally all the way up and make a higher high or just get back up to the same level. But what we see here is we've come down and we've made a higher high here, and so far we've made a lower high in price. So now we just want to be careful that if we rolled over right now, this lower momentum is a place where we kind of get clues that the market isn't ready to go higher yet. So then, so those are the two broad indexes, and then we can go into something like the Dow Jones Industrial. What we see on the Dow Jones Industrial was we did briefly try to take out the prior high. We spent one whole day up above it. So this is February 6th. So we spent that whole day up above it, and then immediately on Friday gapped down and couldn't hold it. So on Thursday rallied all up. This is a 10-minute chart, but rallied all up and just couldn't. There was just running out of buying enthusiasm. Now on the Friday, we were down 660 points on the Dow. Then on the Monday, we had a big rally and a pullback. And then Tuesday, a shooting up rally. And all of these rallies force short covering. So people who expect the market to fall now have to buy to close their trade. And so when they do that, that kind of helps reverse the market. And then as we get up near the top here, basically you got to find somebody who still wants to buy after a 1,000-point run on the Dow. And it's a little harder to come by after it's run up that quick. So then all of a sudden you run out of buyers and the market pulls back gently or quickly, whatever. But my point would be that the 30 Dow stocks are kind of really large mega caps, right? Microsoft, JP Morgan, Apple, really big companies. And so in general, they got up to the prior high and stalled so far. I wouldn't call it anything worse than that, but they stalled. And they made a lower high and got all the way down to almost 0, unlike the NASDAQ composite. But when we go to the NASDAQ 100, this is really the flagship for the bulls. This was our prior high, and we launched right past it. And then we spent the last couple of days just migrating sideways. And what we see on the chart here is clearly running way up here. And again, Tesla's part of that run. I think the gain was something like $60 billion in Tesla over the last few days. And it lost a little bit of that, well, quite a bit of that on Friday or by Friday. But what you see here is this big push up here. This index, clearly the large mega caps, right? I think the top 10 make up over 60 or 70% of this index. It's quite significant. It might be inflated, but it's a dramatic percentage out of the top 10 stocks. What we see here is we didn't even make a lower low on the momentum indicator, where on the other ones we had made a lower low. So as you start to see the market change, what this tells us is that the leading stocks, and nothing wrong with the leading stocks being going higher, the stronger markets, or when the market is really strong, you'll see all the stocks going higher. And so that's the thing that I want to watch for over the coming week, is to see how different it is. So this is the NASDAQ 100. And Tesla is not in the S&P 500 because they haven't had 4 quarters of profitability. So what we see is on the S&P 500, we went up and we made a higher high and then we pulled back. And now we're just kind of gently settling back. But what we worry about whenever we're watching a market is its ability to take out the prior high. And so if we go back down here to July, we had a high, then the market pulled back, spent the month of August down here, and then we got up to that same level. And we just kept oscillating around it and really couldn't do anything. And then we pulled down, and then the Fed started to intervene in the repo market, and off we went when they added liquidity. So now here we have the other situation where we're testing the prior high, and the real question is, can we get back through it? So if you look in the December time frame, we went sideways, 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 and then all of a sudden we popped through it and we went on for another run. Sorry about that. And so what we see here is this is a big pullback. This has the potential to be a big pullback just because the small caps aren't participating. And look at how the volume started to fall away as the market was trying to rally. So again, when we go across all of the different indexes, so the small cap now, let me just go right into those. So what we see here is this made a significantly lower high, and this rollover here is quite concerning. And on this particular stock or index, what we see is we rallied up very suddenly in late or mid January, then pulled back very, very hard, took out the prior lows, went down, almost tested the December 1st low, rallied back up, and now we not only have we not got up near the prior highs, we're actually making lower highs here. And so it's the change in character that we're seeing across the different indexes that can give us an idea of what's working. And so if everything's working, all of these charts are all breaking out to new highs, and it doesn't have to do it on the same day, but it should do it, kind of as the market gets going. It should do it over a week or over 2 weeks. You should start to see them all kind of gather up together. That's what we're not seeing here. So we had a higher high, then we made a lower low. Now we've made a lower high, and the concern would be if we start to make lower lows, that's what we call a downtrend, right? Lower highs and lower lows. So watching the market evolve and rotate here is pretty important, I think. And for me, unless I'm just going to own the top 10 stocks on the NASDAQ, it's probably a more difficult place to be invested. So if we go look at something like the bank index, and what we see here is it made a lower high as well. And normally you want the banks to kind of participate with you. But I think you get the feel just by quickly looking at this chart and looking at the simple analysis we've been doing. The banks set up, even though JP Morgan and Citigroup and Wells Fargo are anything but a small cap, they're behaving a lot more like small caps, where they briefly rallied and are starting to pull back already. And now they're getting stuck under their 50-day moving average, whereas before they were staying above it. So the change in character is what we want to watch for. And now let's just say that this market breaks down here. Well, the next place we'd look for support is down here around the prior low, or this low and this low are pretty close together. So somewhere down in here, and we also have the 200-day moving average not too far away. So if the bankers were going to start to underperform, all of a sudden we'd start to see pressure down around here. Now, even if we get some sort of a bounce, I think what would be the problem with that is we'd look left and we'd say, we started to rally in early October. The banks actually made a higher low, but this is kind of when the big rally kicked in, when the Fed stepped up. That was kind of mid-October, so for us to get back to that same level already, just a few days off the highs of the NASDAQ, we're not getting the follow-through on the banks that we want. So as the market goes forward here, we just want to keep track of these different groups and see what they are. And banks are one of the groups that we'd like to see participate. And obviously the semiconductors, they've made a lower high now too, and they're usually one of the leading groups. And what the Scooter ranking tells us up at the top here is how good this ETF is compared to its peers. And in this case, when it's tucked above this blue line all the time, it's doing very, very well. Now, the real change here is we're starting to make lower highs on the semiconductors, and that could be due to China, that could be due to whatever. But we're starting to see this change in trend where all of a sudden we're making lower highs. We've now made a lower low. We did that back here, but we immediately reversed and went back and made higher highs. So that meant we weren't going to start a downtrend. Here what we've got is we've got a low, now a lower high so far, and we just want to watch and see how this evolves. So on a Friday where I showed you the Dow Jones Industrial Average didn't have much volume, the histogram for the volume was a lot lower on Thursday and Friday. We had a lot of selling coming into the semiconductors on Friday, and what we notice is that the PPO, or the momentum indicator, is down just barely, holding above zero and well below the prior low. So we're starting to make lower highs and lower lows in momentum, and that's not usually a good trait. So as I look across the markets, that's one of the things that's starting to flag to me that we've got things we need to be concerned about, and we should just stay in tune. Now, I haven't shown the S&P 500, but I did briefly show it, but what I want to focus on the S&P 500, again, it's the large cap group, and you can see based on the different groups that we went through that this momentum indicator for the NASDAQ was up nice and high. The NASDAQ 100 for the Dow was down low. For the for the small caps, it was even below zero. And we see that this indicator for the S&P 500 is not it's not as buoyant as it was, but it's definitely not terrible either. So we're in a zone of flux here where we're moving from a big uptrend and potentially could be rolling over, and that's what the other indexes are starting to tell me. So just looking at the advanced decline lines, looking at how the different markets behaved compared to their prior highs, all of that suggests a week ahead of caution. Now, I do want to point out a couple of things over the next week. If you're interested, on the Stock Charts YouTube page, so go to youtube.com, and then, I didn't do that right. Let me just go get my favorites bar, and in here I want to go grab my Stock Charts YouTube. And what we see on this page is
Hello, my name is Dave Keller.
Are all of these articles, but I want to point out that in here, in these articles about morning shows on Stock Charts TV, the market buzz is in here, and I do this twice a week. But the big thing, I don't want the commercial to run here, but the point would be that all of these articles are sitting over here, and it's every Wednesday and every Friday. So if you get a chance, you might want to go in here and check those articles out. I think the biggest thing would be I try to go through an industry group each time, and this week I went through some industry groups like the shipping industry group to check off what's happening with shipping around the world, to monitor kind of the supply chains coming out of China. And then over the previous article was on Wednesday, and a lot of that was about how Tesla was behaving at the time, and I think that was the day it hit its all-time high. So and then this one over here was how to monitor the Chinese stock specifically towards the coronavirus, and some of the Dow names that had been actually underperforming lately. So hopefully you'll find those videos quite interesting. They're roughly 30 minutes at a time, but they're filed under Market Buzz, and they're not filed under the Canadian Technician. So try and check those out. Hopefully, if you are on the Stock Charts YouTube page, this 50 Years of Wall Street is very good, but the other point I want to make is down here at the very bottom are the Canadian Technician articles, and that's what this one is, and you'd be able to go in there and check out some of those. So there's two different places on the YouTube channel to find my work if you're interested. Thank you for taking the time to follow me. Should be an exciting week in the markets. I think we go lower, based on what I've just explained. But the other thing is to stay flexible here, because we could get more intervention by central banks. We could get some good news out of the coronavirus. Any of that could help. So thanks everybody for following. Have a great week. Bye-bye.